I'd like to welcome everyone, particularly Lars Hornuf, to today's Nexus seminar. The Nexus seminar is a seminar series that is co-hosted by UNU Flores, that's United Nations University Institute for Integrated Management of Material Fluxes and of Resources, with my colleague, Professor Serena Coetzee, and together with the Dresden University of Technology, or TUD, and in particular, PRISMA, the Center for Sustainability Assessment and Policy. My name is Samanthi Dijkstra-Silva, and I'm the Coetzee Junior Professor for Sustainability Assessment and Policy. And together with my co-host Serena, I am delighted to welcome all of you today. A little bit of a background on the seminar. The Nexus seminar series was established by the two institutions in 2015, so it's 10 years old, and it features speakers, particularly senior researchers around the topic of sustainability and the resource nexus. Today we have the 85th edition, and I'm really delighted to introduce today's guest speaker, Professor Lars Hornuf, in just a moment. Before we start, a brief orientation for the participants in the session. We'll start with input, a presentation. It will focus on nudging investors towards sustainability. And if you have any topical questions for the speaker that come up, you can post them in the Q&A section, which you can see on the screen. So that's the question and answer section. And then Serena and I will moderate the discussion after the presentation. And should you encounter any technical difficulties, you can use the regular chat function where you will reach the colleagues behind the scenes. And right now that's Asha Vera, who is kindly facilitating the session. And without further ado, I'm glad to introduce today's speaker, Lars Hornuf. Lars joined Dresden University of Technology from the University of Bremen. He's a fellow at CESifo Research Network as well, which I found really interesting, a certified derivatives trader. And prior to that, he was a research fellow at the Center of Finance at the University of Regensburg and an affiliated research fellow at the Max Planck Institute for Innovation and Competition. Lars is a well-cited author, and he's published in numerous highly ranked journals. And with this, I stop with a brief introduction, and I'm very much looking forward to your presentation, Lars, and I would like to hand the presentation over to you now.
Yeah, thank you very much, Samanthi, and thank you very much for having me here at the seminar. As you already noted, this paper is about nudging investors towards sustainability. And we actually collected data from a German robo-advisor. We'll go into more detail about that. But before I start, let me briefly mention that this work was not conducted only by myself, but also by my two co-authors, Christoph Merkel from Aarhus University and Stefan Zeisberger from Radboud University. And here's what actually motivated our study. So you might have realized that during the last month or even years, the attitudes towards sustainable finance have been a bit backlashing in a sense. So on the one hand, here's a citation from the, I believe, Financial Times, stating that as opinions shift, asset managers like BlackRock are talking more about maximizing returns than about saving the world, already showing that apparently investment managers are not so keen anymore in investing sustainably. And on the other hand, we also see empirical evidence that in 2023, for the first time, there was a negative net outflow out of sustainable funds, meaning that less people have been investing in ESG assets. So our question was a bit, what can we do about that? So not from a normative standpoint, but more from an empirical standpoint. And the research question we posed were twofold in a sense. The first thing is what actually determines investment choices in ESG? So why do people do that? And on the other hand, how can we get retail investors to invest in ESG assets? And we know from previous literature, in particular in the behavioral economics and behavioral finance domain, that, for instance, there's this famous project called Save More Tomorrow, using behavioral finance insights that, for instance, if you have employees make a pension plan where they not immediately have to invest, but they get a default stating that with their next increase in wages, a certain percentage will be allocated towards their savings plan, so that it doesn't feel like a loss to them. You can actually see that these plans lead to much better savings for traditional investors. And other examples as well show that default options play a big role. I believe one of the most important examples is organ donations. There is research showing that in countries with opt-out systems, they have consistently higher consent rate for organ donations than in countries with opt-in systems for organ donations, such as in Germany. And so we know that defaults play a big role. The only question is, do they also affect our investment patterns? Before I start with our own experiment, let me briefly summarize what we know from the literature. First of all, I think for people who are not in finance, it's important to know what theory would actually predict. And the theoretical literature on ESG investments and risk and return, I believe, is quite unambiguous in a sense that it would state that if you restrict yourself to ESG investments, and do not invest in an overall diversified portfolio, it is in expectation at least less likely that you outperform the market. So in other words, what you often see is that people might outperform with ESG investments for a certain period of time in the past, but this is actually observed actual returns. But what we are interested in oftentimes is the expectations. For example, if you roll a die, right, you have an expected value of 3.5. You know what should come out in the future, and that is the same for investments. So you would actually know what your expected investments will be in the future. And if you take a sub-portfolio of the overall global portfolio, then conventional financial theory would say there's no way that you can fare better in the long run than with an overall portfolio. Why is that? Certainly also because a lot of investors, for example, do not have a preference to invest in sin stocks such as gaming, tobacco, weapons, and so on. And if there's less demand for these stocks, then obviously these stocks have to provide some incentives that people invest in them. In other words, they have to pay a higher return in order to attract the same amount of capital as other non-sin stocks. So if we then look at not theoretical literature, but empirical literature, what actually comes out of these investments, the evidence is a bit more mixed. So even if you conduct meta studies, and my co-author Gül Yüksel and I did one in the European Financial Management Journal, we actually also found mixed evidence in terms of outperformance or underperformance of ESG portfolios. And the same holds also for risk. So why is that? I mean, to summarize, in theory, we would predict that ESG investments cannot outperform, but empirically, we sometimes see that they do and sometimes they don't. Well, one reason could be in the past years, there has been a lot of demand for ESG assets, and this has been driving up prices in the market, which resulted in higher returns for ESG assets. But that doesn't mean that we also will observe this in the future. So let me turn to the experimental evidence in the next two slides. And I will go a bit deeper into that because this is actually what we also do. We investigate experimentally how ESG investments perform and why people actually invest in them. And there's a lot of evidence starting, for instance, with Riedel and Smith, who are using administrative data and experimental data from a trust game, and find that actually social preferences and social signaling are predictors of SRI, social responsible investment decisions. And financial motives in their experiment play less of a role. Then there's other evidence showing that higher expected future performance and lower expected riskiness predict the inflows of sustainability funds. So in other words, it's because people expect sustainable investments to outperform. This is actually the reason why they invest in them. There's some evidence in the venture capital literature as well where we see that investors accept 2.5 to 3.5 percentage points lower returns for their investments if they get some form of non-pecuniary utility. So, for example, sustainability utility or other forms of non-standard utilities. What else do we find in a paper by Prof. Simroth and myself? We see that actually people invest more in green projects in a crowdfunding context if these people value environmental impact and if they believe that these investments will yield a higher return. Again, getting back to what I said before about theory, well, it's not expectable that these investments should yield a higher return, but some people might believe it and still invest in them. And what we also see is that there's a positive correlation between expectations and the sustainability assessment for common US stocks by Christoph Merkel, one of my co-authors. What else do we find? Well, there's other experiments showing that investors care about the impact, but they don't care about the magnitude of the impact. So that is, in other words, if an investment does something sustainably diligent, that will be great for investors and they will invest in it, but it doesn't matter how big the impact of this investment is. So apparently there's something like a warm glow effect that people just want to feel better that they did the right choice. And it doesn't really matter for them how much of this choice actually or how strongly this choice affects the environment. Then there has been a lot of research looking into click rates or actual investments when people get different framings, for example, through a newsletter. And here you can, for instance, see that if there's a wealth framing or an environmental framing, the wealth framing apparently seemed more effective than the moral framing if investors are supposed to invest. And again, Christoph Simroth and I did an experiment like this where we sent people different newsletters with making the environmental part or the financial part more salient. And there you can actually see that retail investors responded more to an environmental framing than to financial framing in terms of click rates mostly. Then there's also lab experiments where there's artificial environments, not real investments. And you can see that the default options of investors play a big role. But we all know that in these artificial experiments where no real stakes are at stake, that then the effects are often overestimated than in real settings. So in sum, what do we find in the previous literature? First of all, we see that investors often believe that green projects are less risky and more profitable, which goes against the theory in finance. So in fact, we would actually expect the opposite. Investors have a preference to achieve a positive environmental impact. Sometimes it doesn't matter to them how big the impact is, if there's at least some form of positive impact. And we also see that their preferences depend on the choice architecture. However, oftentimes this has been now either tested in some form of artificial lab experiment or only through a framing of a newsletter or something like that, but not the actual investment decisions. So what do we do in this paper? So this paper is different for multiple reasons. So first of all, we test whether at all and to what extent the default, so in other words, the initial setting in a robo-advisor affects sustainability investments. Why is this paper unique? Well, it's unique for several reasons. First of all, we test the preferences of investors in the field. And this is also important. We also do this by having them invest their own money. So a couple of other previous experiments have used field experiments, but then investors have obtained funding from the experimenters. And this will oftentimes elicit the so-called house money effect or experimental demand effect. So people are more likely to take risks if they just get the money donated by the experimenter. And this is all not the case in our setting. So participants invested their own money in the field and they used the real investment setting like they would have invested without our study. So what we also do, we again elicit the beliefs about the performance of sustainable versus conventional investments and the preferences of these investors and see how they actually affect investment decisions. The field experiment was conducted with more than 1,600 new investors that have signed up at the robo-advisor in between December 2022 and February 2024. We pre-registered this experiment in the Open Science Framework. And if you are interested in our pre-registration, you can actually have a look at the link. And the study also obtained ethical approval from the Ethics Commission of the University of Zurich, mostly because obviously we expected that our design changes would affect the performance of the investments of the respective investors. So here's a little bit of information about the robo-advisor. So the experiment was run on one of the most successful German robo-advisors according to current public ratings. There might be some robo-advisors that are bigger in Germany, but that one is actually one of the quite successful ones. It offers sustainable investments as an option, but it was not established as a robo-advisor for sustainable investments per se. So you can do it, but it's not that the crowd which is investing in this robo-advisor is particularly sustainable oriented or not. Before you had to opt in the sustainable investments before we run the experiment. And before we ran the experiment, 26.5% of the investors invested sustainably in 2019 to 2020. Here's the experimental design. So in the experiment was conducted like that. There was this onboarding process for investors, and the investors saw different versions of the website. So in other words, we have a between subjects design, and there could have been different combinations of the defaults. I will show you a picture in a second how the defaults actually looked like. And either you could choose between sustainable or non-sustainable, and either sustainable was already clicked on or conventional was also clicked on. We also pre-registered active choice setting so that people had to actually choose between sustainable or non-sustainable. However, that was not implemented by the robo-advisor, and we only realized in the end that they actually didn't do it. There were other choices you could make, whether you would like to invest in emerging markets or only in European markets or US markets, whether you would like to invest in foreign currencies. These choices often went together or actually had to go together, because if you invested in emerging markets, then you also had to accept foreign currencies. It doesn't really matter for our ESG treatment, but it's just important to know when you look at the different treatments later on. Okay, once they had registered, oftentimes people could also click on the website, and if they didn't immediately register, they could in fact have observed different defaults. So we counted a default at the time they actually registered, and so once they registered, they had also to take part in a survey where we gave them some incentivized questions where we said, like, if you are very good in predicting the performance differential between ESG and sustainable and conventional investments, you might actually get an additional 100 euros paid out in order to elicit their actual preferences. This was done via a pop-up window. And here you actually see the screen of the robo-advisor. So on the left-hand side, you had the initial amount you would like to invest, the monthly payment you would like to do, and then you could actually give a risk scale with 4 scales between no risk at all, then it would not have been possible to invest. And then conservative to very high risk, so 4 scales in total. And then this is actually what is most important to us, right? So it's just like, how would you like to invest? Classic or sustainable. In this case, by chance, classic was the default option. This was also the initial default option, but in our experiment, it could have also sometimes have been clicked on sustainable. And then you had these other 2 options here, consider also foreign currencies or consider also emerging markets. Okay, importantly, and actually this was in our favor, the projections didn't adjust for changes in the 3 defaults. That meant, we didn't nudge the performance beliefs of investors once they clicked on sustainable or classic. So the performance on the left-hand side here would have always been the same. Okay, that was quite good. Then we also had a questionnaire where we asked about beliefs and preferences of these investors. For example, which investments did you choose, just to make sure whether these guys actually remember what they did. So was this an active choice? For which investments do you expect a higher return over the next 12 months in terms of return differential, which we incentivized, as I told you, with 100 euros for the best 10 guesses. Which investments do you believe is riskier, conventional or sustainable? And if risk and return would be identical, which investment would you choose? Or which would be the required return difference that you switch to the other investments? In other words, does ESG has to outperform by 10% that you would switch to ESG, or the other way around? Does conventional have to outperform that you switch to conventional? Then we also elicited the risk, time, and sustainability preferences. Here are our 3 hypotheses that we pre-registered. So first hypothesis that defaults indeed play a role. So meaning that investors with a default portfolio setting of sustainable investments are more likely to decide for sustainable investments. H2, investors expect that portfolios containing conventional and sustainable investments will perform at least as well or carry no greater risk than sustainable investments. So that comes from theory, right? Having also sin stocks in your portfolio should yield a higher expected return. And H3, investors who choose to invest sustainably are driven by sustainability preferences and are willing to give up at least some of their returns in order to benefit from this sustainability from this sustainable investment. Here's the participants. So in total, they invested almost 8 million euros and had a recurring investment of almost 200,000 euros. There was some sample attrition. So in the end, we counted 1,343 accounts that were still active at the end of the observation period. In total, more than 500 investors also took part in the survey, which is quite nice because this is a response rate of around 30%. And most of the investors recalled their initial investment choice, indicating that they actually realized what they were doing. Here's some summary statistics. So as with many digital offers in finance, most of the investors were male, on average 46 years old. 1/3 overall invest sustainably. That means the rest, 70% roundabout, didn't invest sustainably alone. And the initial investments are highly skewed, meaning that very few people invested much higher amounts, up to 40,000 euros, as you can see here in the top 5 percentile. And on average, it was 9,320. Okay, same for the monthly amount. Again, here you see some people invested 500 in the top 5 percentile relative to 150 on average. So here's the key result of our research. So what do we see? So if you change the default options, and remember in traditional economics, you would say defaults shouldn't play a role. because people have stable preferences. If they like to invest sustainably, they will actually do it and they will click on it. But what you see is actually that if classic is the default, then we have 23% of people investing in conventional investments. But if sustainably is the default, we see that 36% invest sustainably. So in other words, this is an increase by either 13 percentage points or an increase by almost 56% in sustainable investments. Now you could say, well, is this particular to sustainable investments and conventional investments? No, it's not. If we change the defaults for foreign currencies or emerging markets, the effect sizes are almost similar. So meaning that the default effect is not particular to sustainable investments. It happens somewhere else as well, and it's big in magnitude. The next thing we did was we checked whether people actively opted in or opted out, and this also gave an interesting picture, namely the following. If you look at foreign currencies or emerging markets, you can see that people are more often actively opting in. So the percentage of those is often above 70% who are actively opting in, and fewer people are opting actively out. But for sustainable investments, it's actually the opposite. You can see that once it's clicked on, more people are actively opting out and few people are actively opting in. Now, this is only descriptive. Now you could say maybe that correlates with other choices. And what you here see is a little regression, and it actually gives you our three default options: sustainable investments, emerging markets, and foreign currencies. And you see out of these three, the sustainability default has a significant and robust impact. In this case, between 12 and 13% increase in sustainable investments if this is the default that is clicked on. You also see that risk choice plays a role. So in other words, the risk choice, so the lower risk you are willing to choose, the less likely it is that you invest sustainably. The other coefficients for the investment amount, the gender or age, did not play or have a significant effect here. So what's the summary on this H1? Defaults have a strong impact on investment choices. There is a 13 percentage point difference if sustainable investment is the default, or more than 50% increase. However, still more than 60% opt actively out of sustainable investments if this is given the active choice, if this is the actual choice. And there seems to be a trade-off among investors between risk and return and sustainable investments. So next thing we looked at was the beliefs about risk and return. And here you see that there is a significant difference between sustainable investors and conventional investors. So if you ask these people what they actually believe will be the return and whether sustainable investors or sustainable investments have a higher return, you can see that these people who are investing sustainably, 60% of them believe that sustainable investments will actually outperform, which is not in line with theory, right? Conventional investors are more in line with theory. You only see that 3% of them believe that sustainable investments will outperform, which they shouldn't, at least in expectation. Then again, sustainable investors, you see, in line with previous empirical research, believe that sustainable investments are less risky compared to conventional investors. And if you look at the risk-return trade-off, when you ask investors, what do you think? Do conventional investments perform better than sustainable investments? You can see that here the conventional investors believe much more that conventional investors outperform relative to sustainable investors who do not believe that conventional investments will outperform, which they should in theory. So the next thing we asked ourselves is, like, by changing the defaults, did this actually affect the beliefs of the investors? And here again, we differentiate between sustainable and conventional investors. And you can see for most of the measures, beliefs, and preferences, you couldn't see that there's any difference, except for here, sustainable dominates. So in other words, does sustainable perform better than conventional? You see that the sustainable investors, the sustainability default had an impact on the beliefs, namely that sustainability dominates or performs better. Then we had a quite interesting result, which we call anti-woke investors, which means the following. So we asked them, which investment would you choose if risk and return were identical? And then if risk and return were identical, then 78% of investors would choose the sustainable investments. So they would do something good for the environment. However, 22% of investors would say that they invest conventionally, even if the risk and return for sustainable and conventional investments were identical. So in other words, sustainable investments would not have a negative consequence for performance, then still 1/5 or every fifth investor would still go for conventional investments. So which could be a kind of anti-woke interpretation. On average, investors require 3.1 percentage points more return to switch to conventional investments. So in other words, if you are invested in sin stocks, then you need to pay 3.1 percentage more that people actually switch to this immoral stocks. For sustainable investors, this is obviously higher, 4.8 percentage points. For conventional investors, it's only 2.1. Conclusion 2, beliefs are very different between sustainable and conventional investors. Investors on average believe that conventional investments will outperform, but many green investors believe that actually sustainable investments will outperform. But we also find that defaults to some extent affect beliefs, even though these defaults were randomly assigned, and so they still had an effect on the beliefs. If we look at preferences, we ask them different questions, for instance, about the importance of sustainable investments. For instance, we ask them relative to other decision criteria, how important is sustainability in your investment decision on a scale from 1 to 4? And you can see that defaults in this case didn't have any impact on their preferences, which is good. Then we included all of these beliefs and preferences into a huge regression, also accounting for risk preferences and time preferences, age, gender, and so on. And what you see here is, again, first of all, our default still has a significant effect, even though the effect size gets a little bit smaller. And you can see that it's no longer this 14% that we have observed before. It even goes down to around 7% over a year. But here the sample is a little bit smaller because we only consider those guys who actually took part in the survey. And you can again see that risk plays a role and has a negative impact on your investment decision to invest sustainably. But you can also see that if you believe that sustainable investments have a higher return by 1 percentage point, then you can see that 6.5% would invest more sustainably. So beliefs about the returns play a significant role. If you believe sustainability is important or has so the impact is important to you, then again, you see this has a positive impact whether you invest sustainably. What else we did was we grouped the preferences of these guys in 3 groups. So in other words, those who are most sustainability oriented, intermediate, and least sustainability oriented. And what you see here is that independent of what you believe your return will be by a sustainable investment, you can see that those who have sustainable mindset invest a higher fraction of their money into sustainable investments. What you would actually believe, right? That makes sense. And then for the other 2, the intermediate group and least sustainable minded, you see that these people invest a lower fraction of their investments into sustainable investments. But what is interesting is you can see for all three groups, so if they believe that the relative return of sustainable investments is higher, so here in the end, you see that sustainable investments perform better than conventional investments. So if that's their belief, then you can see the investments of all three groups increase significantly relative to those guys who believe that the return expectations of sustainable investments are lower. So last key finding. So now you could actually question whether people make consistent choices in a sense that on the one hand, we ask them what is the actual return differences where you would switch if you're conventional investors. How much more would I have to pay you for sustainable that you actually go to sustainable, or vice versa? If you are a sustainable investor, how much more in return would I have to give you that you go to a conventional investment? And then we also ask them what they actually believe, how better the other investment performs. So in other words, if you would say if there's an outperformance by 5%, so here, if there's an outperformance by 5% of conventional investments or sustainable investments, respectively, and you would expect that, or if you expect that there's this outperformance, and you say if this is the case, this outperformance, then you would actually switch. Then you should be on the upper left-hand side of this chart. So in other words, the red dots are all the conventional investors. So they say, for instance, here there are a couple of red dots, in total a bit more than 60, stating that I believe that sustainable will outperform. And they say if it's indeed outperforming, I would switch, but they don't do it. So 60%, or not 60%, 60, more than 60 investors in total. For instance, here, these red dots believe that sustainable will perform a little bit better, and they argue that they would switch, but they do not switch and they do not become green investors. Now, the question is, why don't they? And the answer here is that at least a couple of them, almost half of them, also believe that sustainable investments are much more risky. And for that reason, they potentially might not switch to become sustainable investors. So what's the conclusion from for H3? First of all, we see that the default settings still play a significant role. So in other words, changing the default to sustainable investments still has a strong impact of at least 7% for investors to invest sustainably. And on the other hand, we see that financial motives and also the importance or the preference for green investments still have an important impact whether people invest sustainably or not. But yet again, if we look at the overall investments outstanding, and if we would change the defaults everywhere in the world, we would probably have a higher investment amount in sustainable investments by 1 trillion if all of these defaults would have been set to default given our results. Okay, so thank you very much for your attention. I'm very much looking forward to your questions and comments.
Thank you very much, Lars, for sharing the insights into your research. I'm going to invite the participants to share your questions in the Q&A session so that we can ask Lars. While we wait for you to type in your questions and while they pop up, I do have a question. So thank you for this really interesting presentation. It was very nice to hear it. I was wondering how, and forgive me if I missed this, but where did you define sustainability for the sample? So did they know what was meant by sustainability?
That's a very good point. Yeah. So So this is something the robo-advisor defines for itself. So I would have to check up, but the robo-advisor follows a strategy by either taking out sin stocks or using investments that are at least in an ESG category of X or Y, and then it would have been included. I would have to check exactly how they did it, but this was determined by the robo-advisor.
You. Thanks. So then we have a question by Bertie, and Bertie asks, in the context of e-waste, how can we nudge investors to support circular economy initiatives such as sustainable electronics productions or ethical recycling operations in the global south? I'm curious, Lars, if you have an idea on this.
Well, that's a very good question. I mean, I have some opinions on that. I'm not sure I can draw this out of this research, but I also recently gave a TED talk on sustainable investments and arguing that nowadays, like, you know, there's ESG reporting, there's ESG ratings, and so on. And then at least for the ESG ratings, there's well-cited research showing that these ratings are not even correlating with each other. And people are saying, yeah, because they take a focus on different things. And you think like, yeah, that's exactly the problem, right? And from a finance perspective, I mean, I would be interested in the actual material impact of these investments. But I don't see that this is actually currently taken care of in the ratings or in the reportings. I think a lot of the reporting initiatives, like from ISRF, are more about standardizing reportings. But then the question is, how does it actually impact things like circular economy, biodiversity, and so on in reality? And I don't see that on the financial market a link is drawn between the material impact and the investment choices. So I don't see that ESG ratings are doing this. I would expect that potentially some startup or some PhD scholar might be able to use AI or Gen AI in particular to come up with a solution for that. And I would be very much in favor of this and would be happy to support it actually.
Thank you, Lars. I have a second question from Matthias. Matthias is wondering if you think for institutional investors, whether results would be similar or different, which one for hypothesis 1, 2, or 3?
Yeah, good question. I mean, we know from other behavioral finance research that behavioral effects diminish to some extent for professional investors. And I probably would expect this to hold here as well. On the other hand, we have also seen that, for example, in the context of German robo-advisors, some of them followed a lot of behavioral biases that humans and retail investors are actually prone to have. And you could also see that professional investors had the same biases and followed the same patterns. So I would not say that it's completely out of scope that professional investors would also, in a sense, be nudged by these default options.
Thank you. And then there's another question by Matthias. On slide 24, you talked about beliefs. How could they be measured?
Let me go back here. 24. Yeah.
Showing 20. Yeah, no. Yeah.
Okay, yeah. So, yeah, I mean, we did a couple of different things, right? I mean, for example, we used incentivized measures where we asked people what they believe will be the return difference between conventional and sustainable investments. And then obviously investors, in particular retail investors, might have difficulties to come up with the actual percentage point of the nominal return. So for that reason, we only asked them, what do you think, which one is performing better? And by which percentage point do you think that this is performing better? And because we wanted to have revealed preferences and not stated preferences, this is the part where we incentivized investors and told them, listen, if you get it straight and if you are making a good prediction, the best 10 predictions of how the portfolio will actually outperform will be awarded with 100 euros after 1 year. And we just paid this out to some of the investors. So some of them were actually very good in making this return prediction.
Thank you. We have another question and comment from Yichi. It's thanks for the interesting talk. What makes people have sustainable beliefs that do not align with theory?
Oh yeah, that's a good point. One thing is obviously that there's a lot of beliefs being mixed up, right? I mean, one is I mean, probably one thing is people cannot differentiate, that's my feeling, between expectations and previous averages, right? I mean, if you look at observed returns, you might say, well, I've seen that sustainable investments have outperformed in the past, right? I mean, if you look at the returns after the Fukushima blow up, right, then you see that the sustainable investments are performing much better than conventional investments. And you might say, you see, this is theory driven, right? You could say this is because why sustainable investments should perform better, because there's an ethical component to this and it will not go away. But you have to see this is not how finance works, right? I mean, the question is, how much do you have to pay in order to obtain capital? What's your cost of capital? And then you could say, well, if I'm a gaming company driving uh, families into bankruptcy, if I'm a weapons producer, or even though we are not sure anymore whether this is not actually helping us to foster democracy nowadays, right? But usually I'm not getting as much capital as others, and for that reason, I should actually pay a higher return that I can attract the capital that I need. And so obviously there are, for individuals, it's difficult to understand what the difference is between expectations or expected returns and past returns. And I think this is probably one of the reasons why they're not acting in line with theory. And one thing I forgot to mention is that actually now collected the data also more recently and checked how people adhere to their initial investment choices. And what you see is that even a year after the end of the experiment, the default options still have the same effect as before. So it's not that they have second thoughts and think like, maybe I should change after I engaged in the sustainable investments in the first place. After I get this nudge via the default option, you can actually see that this 30 percentage point difference remains even today.
Thank you for that. Yeah, I also had a question around those lines and whether we perhaps also need new theory around that. There's another question by Matthias, and that's about the role of AI, and it's how do you see the role of AI for institutional investors?
Oh yeah. So I'm thinking there's a big chance, like in terms of what we discussed before, right? In terms of that you uh, draw a line between the investment and how it will have a material outcome. I mean, how we think in finance about sustainable investments is probably the money goes into the company, it yields a return on investment, but it might also have a sustainable material outcome. And I would be interested. Obviously, you always need to know that ex ante, so that you need to know before you make the investment what the expected return and what the sustainable outcome in a material sense will be. And my feeling is that unlike ESG ratings and reportings and all of this stuff, which is based on certain scales, which then you have to weight, and this is all human driven, and you don't know whether that's a good weighting or not. That you could actually use more generative forms of AI to come up with a prediction or with scenarios or even distributions in a mathematical sense about what the material impact of a certain investment will be. And I think there lies a great chance, and I would very much favor that over the current ESG ratings and reporting standards that we have.
Thank you for that. So that were the current questions from the audience. If you have, I would allow for one more question from the participant, if that's okay, Lars. I have a question for you as well, and that's about we have quite a few PhD and also master students here. And from your perspective, this was, I think, quite a huge experiment and empirical data analysis. So from your experiments, is there something that you can share with us, like early career researchers that embark on such a journey on the learnings?
Yeah, I mean, in the end, it's worthwhile. I mean, like you said, like it has been a long running experiment. I mean, as you can imagine, right, we collected the first data in 2022, and even before that, we had to prepare it, right? I mean, we had to come up with the ethics approval, with the pre-registration. We had to bargain with this bank in order to be allowed to do this. They had to check it with the market supervision BaFin, whether they are allowed to do it. But in the end, I think nowadays it's one of the first papers, if not the only paper, which studies investors in a natural setting where they invest their own money and we manipulate the investment decision in a real life environment. And how much better can it get, right? I mean, you can always run a lab experiment, but then it's artificial, and we see that these lab experiments are overestimating the actual effect. And once you have done it, I think you're quite happy about it in a sense that, like, that your experiment has a lot of assets and a lot of things to offer, and you will not be afraid to submit it also to a top journal because, you don't need to have fixes for problems that you could have solved early on, right? And I would say that is something, obviously, if you have a tenured professorship, that's easy to say, right? And you can always say, like, yeah, I have the time, it doesn't matter. Whether it's finished in 5 years or 10, it doesn't matter, right? But on the other hand, if you have this in the pipeline, I think it's a nice thing. And obviously, then if you have a postdoc phase or something else later on, and oftentimes if you get hired nowadays, it's not so much about whether you have already finished the paper and it's published. If you can show like you have submitted it or you have this great idea and it's implemented and you have the potential to get it out well, other universities will certainly appreciate that. And don't be afraid of, in German we have this saying that you have to put a hole into a big piece of wood or dicke Bretterboom, as we call it, right? And don't be afraid of doing this, right? I mean, don't go for the easy solution, even if the tricky solution will not be perfectly finished by the end of your PhD, you will still benefit from it.
Thank you, Lars. I think that calls a little bit also to take a riskier route.
Yeah.
Get some really, really nice and interesting data. Lars, thank you so much for joining us today and for sharing your research. I really enjoyed it. It was very interesting. Thank you also for the participants for listening and asking questions today. I wanted to let you know that we will be off for July, August, and September, and then we'll reconvene with the speaker series from October. And so that's because here in Europe it's summer and that's the semester break that is coming up. So I wish you all a wonderful time. And I hope you'll join us again in the summer semester. And again, Lars, thank you very much for joining us and for sharing your research.
My pleasure.
Say bye to everyone.